Iron Condor is going to be a pairing of a bull put spread and a bear call spread. With a bear call spread, our motivation, or I should say our forecast, is neutral to moderately bearish, right? Hence the bear call spread. With a bull put spread, we are neutral to moderately bullish on the underlying. The common denominator in there is what? Neutral, right? We don't expect a lot of market movement. With an Iron Condor, it puts the two together, and we're looking for very limited, if any, price movement in the underlying stock. So what we do is we take our put credit spread, right, our bull put spread, neutral to moderately bullish. We take that and we pair that with our bear call spread, neutral to moderately bearish. So we take the two spreads together. It's a 4-leg strategy. We trade it under one ticket, typically when we initiate an Iron Condor. We're selling a bear call spread. We are selling a bull put spread. So 4 legs together, that's going to be our trade. And what we get is the Iron Condor. And here's an example. Again, 87.5 is going to be our stock price. We got 28 days to expiration. On the downside, we don't expect shares to drop below 85. On the upside, we don't expect shares to eclipse 90, right? There's our range bound. That's where we want those shares to finish. So on the upside, we've got our maximum target of $95. Just in case we're wrong, remember, we're selling a spread. So we think that the stock range is going to be between 85 and 90. That $90 upper price limit, that's going to be our target where we sell our short call. Just in case we're wrong, we're going to buy that insurance. That's going to be a 95 strike call. Let's see if I have those here. So with our call spread, $90 is our target. $95 is going to be our long option just in case we're wrong. On the put side, $85 is going to be the bottom end of our target. We're going to buy an $80 put, again, just in case we're wrong. All right? Nobody's ever right 100% of the time trading options. Most people are right significantly less than that. So for protection, it's, we like to make sure that we're covered just in case things don't go the way that we expect. So a typical Iron Condor generally has equidistant call strikes and equidistant put strikes centered around the underlying. It doesn't have to be that way. You can skew either leg, so you can trade a more narrow or a wider range on the put side. You could trade a narrower or more wider range on the call side. And then you could skew it around the stock price. You could move the puts closer to the at the money. You could move the calls closer to the at the money, depending on your overall opinion. Maybe you're not so much neutral as you are a little bit more neutral to bullish, so maybe you skew your calls a little bit. But the point being is that they're typically structured with puts equidistant and calls equidistant, not only from each other, but from that center stock price. And in our example, we've got the 80-85 put spread. We sell that. We sell the 90-95 call spread. Because we are selling two spreads, theoretically, we get double the premium. So now we can sell both of those and collect over $3 or over $300 in premium for the contract. Because we're net sellers, right, nothing changes. That net sale price is still going to be our maximum profit. The risk that we have is going to once again be the difference between the strike prices minus the premium that we collected. Now, the interesting thing about a condor is that you can only win or lose on one side. So meaning that you're never going to lose on the put side and the call side at the same time. You're never going to profit on the call side and the put side at the same time. Only one of those spreads are really going to be in play. But the reason we're trading both of the spreads is because we don't necessarily know or for that matter, care which direction the market goes. If the market moves a little bit up, or if it moves a little bit down, we can still profit both ways. So that's why we're trading both of those spreads at once. And it's also because we have that range. We were expecting the stock to trade within that 85 to 90 range. Thank you. Here's our graph, right? We take the two profit and loss graphs, we put them together. You can see how it's centered around the stock price. That's going to be our orange line centered around the stock price of 87.5. You can see if we move up a little bit, we're still in the profit. If we move down a little bit, we're still in the profit. If stock stays between those two short strikes, between the 85 and the 90 strike, that's where our maximum profit is. That's where we retain 100% of this premium. Our break-even points, 93.05 on the upside, 81.95 on the downside. Any place in between those two break-even points, we're still going to be profitable. And remember, we were expecting this stock to be range-bound. We were expecting it to stay between 85 and 90. Well, it turns out with this trade, we're still going to make money even if it stays between roughly 82 and 93. So we've got a little bit of extra cushion where we can still make money. But if we're wrong, let's say we finish between the call strikes. All of the put strikes would expire without value and unexercised, likely unassigned, and that's done. So now all we have is the call side to worry about. So if stock finishes, between $80 and $95, let's say it finishes 94, we're going to have a stock position. Our short 90 call is we're going to be forced to sell our shares at 90. Our long $95 call is going to expire without value. So what do we have left? We've got a short stock position from $90. Shares are trading 94. $4 loser on the stock minus the premium that we collected when we initiated the trade. And that would be our profit and loss based on a $94 stock price. But anywhere in between those strikes, whether it's on the call side or the put side, we're either going to be long stock or short stock, and we would have to manage that position accordingly.